Hey guys, welcome back to a brand new video. I'm RexFinance, and today we need to talk about the Federal Reserve and specifically our best friend, Jerome Powell. Next week is going to be a very pivotal week for the entire stock market because we get our lucky Jackson Hole meeting, which if you guys remember last year's Jackson Hole meeting, it wasn't pretty. Jerome Powell literally crashed the stock market after he got done speaking at the Jackson Hole meeting. Yeah, on the S&P 500 chart, that's what this last big dip in last year's bear market is, this last 12%. All attributable to the Jackson Hole meeting of last year. Next week, on Thursday, is this year's Jackson Hole meeting, and I believe this is going to be just as pivotal as last year's meeting. We all know since the beginning of August, it's been a sell-off month, with the S&P 500 down basically 5% this month, and we're only halfway through August. With this meeting taking place next week, I either believe that this sell-off is going to continue in a big way, or I believe that the stock market's going to bounce back, the bull market's going to come right back, and all the stock market indices are going to close at all-time highs by the end of this year. Now, yesterday I made a video called Bears Will Be Wrong Again, where I dove into the current bearish thesis and the bearish argument in the stock market. And yes, this hasn't changed. I remain very, very bullish throughout the rest of 2023 and going into 2024. But again, with this Jackson Hole meeting taking place next week, my thesis could quickly change on this. In that video, I dove into a lot of different data points and showed you why I remain bullish. However, in this video, I also mentioned a few different items that do concern me. And all these things are converging for the Jackson Hole meeting next week. I don't know, you guys might want to take a shot every time I say Jackson Hole meeting in this video because I've already said it about 10 times and we're like a minute into the video, so good luck. But if you guys are new here or returning and not yet subscribed, I would greatly appreciate hitting that subscribe button down below because we're one of the fastest growing stock market YouTube channels currently, and I'm biased, but it'd be pretty fun to maintain that trend. Also, leave me a comment down below whether you think the stock market's doomed or we're gonna return to glory. But the first concern that I mentioned was the commercial real estate market currently. You see, as a result of the pandemic, telework has become a bigger and bigger thing, which has led to a dramatic reduction in the need for office space, which could cause a correction in the values of office buildings and downtown retail properties that largely depend on office workers. You see, currently there's basically $3 trillion of commercial real estate loans outstanding that banks hold themselves, and we can see based on this report by Commercial Edge that the national vacancy rate for office buildings and commercial real estate was 17.1%, up 180 basis points year over year. There are 6.8 billion square feet of office space in the United States of America, and a 17.1% vacancy rate means that 1.2 billion square feet of office space is vacant right now. That's quite a bit, and that percentage keeps rising and going up. If we have vacancies, these commercial real estate holders aren't going to be able to pay their loans, which could lead to credit losses. In fact, lucky for us, the Federal Reserve explains this for us in the sustainability report that was released in May. They say with CRE, commercial real estate valuations, remaining elevated, the magnitude of a correction in property values could be sizable and therefore could lead to credit losses by holders of commercial real estate debt. If these property values drop, the commercial real estate borrowers aren't going to be able to pay off their loan, which could result in these credit losses that we're talking about, because at that point they'd have to refinance their loan in order to meet the payment obligations. But with interest rates going up, it makes no sense and it becomes very, very difficult to refinance your loan. As a result of that, we're expecting a lot of these borrowers to default and these banks that hold the vast majority of commercial real estate to sell their commercial real estate for pennies on the dollar. Now, lucky for us, the Federal Reserve has come out and said on many occasions that they're watching this scenario closely with commercial real estate. In this sustainability report, they say, in response to concerns about CRE, the Federal Reserve has increased monitoring of the performance of CRE loans and expanded examination procedures for banks with significant CRE concentration risk. We also had Jerome Powell in his June FOMC meeting press conference say that he's watching this very closely. Now, yes, just because they're watching it doesn't mean that we'll avoid some credit crunch, which would cause a recession in the economy, which is the risk that we could see with commercial real estate. The second risk that I mentioned in yesterday's video was the rising bond yields, particularly of the 10-year Treasury, which popped over 4.25% yesterday. The reason this is such a concern for me personally is because increasing bond yields lead to valuation crunch in the stock market. And if you've been following the stock market at all, you would know that a certain 8 tech companies have been headlining and spearheading this entire stock market rally we've seen throughout 2023. In fact, if it weren't for these 8 companies, the stock market would have negative returns for 2023. That's how important these 8 tech companies are for the stock market currently. These 8 companies that I'm talking about are Alphabet, Amazon, Apple, Meta, Microsoft, Netflix, Nvidia, and Tesla. We call them the Mega Cap 8. The reason they have performed so well in 2023 is because of this AI hype. Now, we're going to know really soon whether this AI hype is legitimate. If it is legit, the valuations that these companies are trading at are probably fair. Just a couple of weeks ago, towards the end of July, these Mega Cap 8 stocks were trading at a forward PE multiple of 32. Now, throughout the month of August, we've already discussed, we've seen a stock market sell-off, and that is a direct result of Treasury yields going up. This is where I come up with my thesis that Treasury yields going up creates valuation crunch, and these Mega Cap 8 stocks are the most susceptible to this because their valuations are so high. This is evidenced by the fact that during the first 11 months of August, the forward PE multiple on the Mega Cap 8 went down from 32 to 28. Now, the next time we get an update on this, we're more than likely trading at a 26 forward PE multiple on the Mega Cap 8. Next week, set your calendar, we get an earnings report from Nvidia, which is perhaps the most pure play on this AI hype there is. This could be the make or break for this AI hype. Is it here to stay? Or is this just a fad? I believe that it's legit, but we're going to find out relatively soon based on Nvidia's earnings release. But everything I just talked about with bond yields and the Mega Cap 8 and this AI hype is perhaps why Michael Burry decided to short sell the tech stocks. Without the tech stocks, we would have a negative stock market return in 2023. Michael Burry pretty clearly is seeing a bubble with this AI hype. And if he's right, he's going to make a lot of money. And if he's wrong, he's going to lose a lot of money. And lastly, the third concern that I had in yesterday's video was the ballooning government debt and interest expenditures as a result of that debt. In Q3, our government is going to pay more than $1 trillion in interest payments on its outstanding debt. Think about that, $1 trillion. How they come up with that $1 trillion is they print more money. They create more money to pay the interest, which can create inflation. At some point, I hope it's not in my lifetime, this will crumble. This will fail. This is not sustainable for our federal government. And rising interest rates exacerbate this problem. A lot of the reason you're seeing this huge increase in interest expenditures on the government's debt is because of interest rates going up. But it's not just the government debt or the interest payments that has to do with rising rates. All of these issues have to do with rising rates. If interest rates continue higher, that will cause more defaults on commercial real estate mortgages, which will create credit losses, which could lead to a credit crunch, and hence we'll see a recession. Furthermore, we more than likely would have to deal with deflation rather than inflation towards the end of 2024. Right now, the goods sector of our economy is already deflating. Goods are going down in price. We have negative price growth in the goods sector of the economy. And if we look at the CPI data excluding shelter, the reason we take shelter out is because it has a lot of lag effects before current prices actually hit the CPI data. We know based on the more current data we can get from Zillow and the apartment list index that shelter and rent rates are going down. So we know that no matter what, inflation in the shelter sector is coming down, and eventually that will hit the CPI data. But the lagged effects in shelter are preventing that data from reaching the current CPI data. That's why we strip it out. And without shelter, which we know is going to fall, the headline CPI rate is at 2%. That is the Federal Reserve's target. Core CPI, excluding shelter, is at 2.5%. This is no longer a battle. The battle against inflation has been won, but the Federal Reserve has yet to declare victory. The reason bond yields are soaring and the markets are pricing in future rate hikes is not because of inflation. We've won the battle against inflation. It's that our economy is running very, very hot right now. The Atlanta Fed is projecting our GDP to grow by 5.8% in Q3. 5.8%, almost 6% GDP growth in a quarter. The risk with a very hot economy is that maybe as a result of this hot economy, inflation is going to remain slightly above the 2% goal for quite some time, unless the Federal Reserve raises rates even further. And Jerome Powell has been very, very adamant that no matter what, they will get the inflation rate down to 2%. They're not going to settle for 2.5%. They're not going to settle for 2.3%. They'll settle when they get to 2% or lower, which is why the markets are concerned that interest rates are going to have to go higher. However, as I was just discussing, the Federal Reserve is in quite a predicament right now. They don't want the commercial real estate market to collapse because then we'll see a recession and there will be lots of pain in the economy. They also don't want to have to fight deflation, which is what would happen if interest rates move even higher. And if rates move higher, the stock market would fall because of valuation crunch and the economy would hurt as a result of that because of the wealth effect. If people have less money, less net worth, they're less likely to spend money, which hurts the overall economy. And then you also have the pressure of the government debt and the interest payments there. If interest rates go higher, that debt, those interest payments are just going to balloon more and more and more, which raises the risk that some sort of catastrophe could happen. So in my opinion, I don't think Jerome Powell has a choice, which is why I remain bullish as of now on this Jackson Hole meeting. I think he has no choice but to come out as dovish and say that, yes, we have mostly won the fight against inflation. Maybe there's going to be some residual inflation, but we're going to bring back the FATE term, flexible average inflation targeting. If we remain slightly above 2%, we're okay with that as long as that rate goes down below 2% in 2024 and in 2025. But if he doesn't come out as a dove and he comes out as a hawk instead, I will change my tune because of all of these risks I've laid out in this video. I don't think that him coming out as a hawk would result in a strong economy and a strong stock market. I think quite the opposite, and I would get very, very nervous. But again, for now, based on the research I've done, I remain bullish, and no matter what, I'm not going to sell out of my stocks because I'm 22 years old, and I'm going to stay invested in this market until I retire, if not until I'm 6 feet under the ground. Buying and holding beats trying to time the market any day of the week. If you guys want more in-depth videos like the one I did today, join my membership down below. Hit the join button located right next to the subscribe button or hit my Patreon link in the pinned comment. I do deep dive videos like this every single week. If you guys are new here or returning and not yet subscribed, I would greatly appreciate that subscribe button. We're one of the fastest growing stock market YouTube channels currently. It'd be great to maintain that trend. But with that, have a great rest of your day. Keep 10 toes to the ground and your chin up. Stay blessed. Peace out.